Most of the world's wealthiest people didn't get there by working a 9 to 5 job. They got there by owning dirt, bricks, and mortar. If you want to be rich, you have to stop thinking like an employee and start thinking like a landlord. Real estate isn't just about finding a place to live, it is a machine for building generational wealth. Let me explain exactly how this engine works. The foundation of real estate wealth is leverage. Imagine you have $50,000. You could buy a mutual fund and hope for an 8% return. That gets you $4,000 a year. Not bad, but it won't make you a millionaire anytime soon. Now, imagine you use that same $50,000 as a 20% down payment on a $250,000 rental property. You now own an asset worth $250,000, even though you only put up 50,000 of your own cash. The bank provided the other 200,000. When that property increases in value by just 5%, you aren't making 5% on your 50,000. You are making 5% on the entire $250,000 asset. That is a $12,500 gain. On your original $50,000 investment, that is a 25% return. That is the power of other people's money. But leverage is only the start. Real estate offers four distinct pillars of profit that other investments simply cannot match. The first pillar is cash flow. This is the rent money left over after you pay the mortgage, the insurance, the taxes, and the maintenance. If your tenant pays $2,000 a month and your expenses are $1,500, you put $500 in your pocket every single month. That is passive income. You don't have to trade your time for that money. You make it while you sleep. The second pillar is mortgage paydown. Every month, your tenant writes a check that pays off your debt. Each payment slightly increases your equity in the home. You aren't just making profit, you are having someone else buy the house for you. In 30 years, the house is free and clear, and the entire value belongs to you. The third pillar is appreciation. Historically, real estate values rise over the long term. Since 1963, the median sales price of a house in the United States has risen from roughly $19,000 to over $400,000 today. Inflation acts as a tailwind. As the value of the dollar drops, the value of physical land usually rises. You are protected from the eroding power of printing money. The fourth pillar is the tax code. This is where the truly wealthy play the game. The government actually encourages you to buy real estate. You get to deduct mortgage interest, property taxes, and operating expenses. Then there is depreciation. The IRS allows you to deduct the value of your building over 27 and a half years as a paper loss. You can show a loss on your taxes even while your property is putting cash in your pocket. You get to keep more of what you earn. You might be thinking this sounds like a lot of work. You are right. It requires research, due diligence, and the ability to manage people. You have to understand a market. You need to know the difference between a cash-flowing neighborhood and a money pit. The most successful investors use the rule of 1%. This rule says that if you buy a property, the monthly rent should be at least 1% of the total purchase price. If you buy a house for $200,000, you should aim for $2,000 a month in rent. If you can hit that target, you are almost guaranteed to cash flow. It is also important to understand the concept of a cap rate. This is your net operating income divided by the property's current market value. If a property generates $10,000 in profit per year and the property is worth $200,000, you have a 5% cap rate. This helps you compare properties across different cities and different states. It removes the emotion and leaves you with the cold, hard numbers. There are different paths to take here. You could go the route of the small investor, buying single-family homes one by one, or you could scale up to multifamily units, where you have 10, 20, or 50 families living under one roof. When one tenant moves out in a single-family home, your vacancy rate is 100%. In a 50-unit building, if one person leaves, your vacancy is only 2%. Scalability reduces your risk. Many people are waiting for the perfect moment. They are waiting for interest rates to drop or for the market to crash. History shows us that time in the market beats timing the market. In 2008, when the housing market collapsed, Those who were terrified sold everything. Those who understood the engine of real estate bought everything they could afford. Warren Buffett once said that the stock market is a device for transferring money from the impatient to the patient. The same is true for real estate. Do not be discouraged by the scale of the task. Everyone starts with their first deal. Some start by house hacking, where they buy a duplex, live in one side, and rent out the other. The tenant pays the mortgage, and the owner lives for free. They save the money they would have spent on rent, save for a down payment on the next property, and repeat the process. It is not a get-rich-quick scheme. It is a get-rich-certainly scheme. It takes discipline to save the initial capital. It takes courage to sign the loan documents, and it takes persistence to manage the property over the years. But the outcome is mathematically superior to almost any other method of wealth creation. You have to decide if you want to keep trading your life for a paycheck or if you want to build an asset that pays you for the rest of your life. The houses are already built, the land isn't going anywhere. The only thing missing is your decision to start. If you could own one asset that would pay you for the next 50 years, would you let a little fear stop you from acquiring it? Or would you choose to learn the math and build your own empire? The difference between the rich and the rest is not the money they have today. It is the assets they decide to keep. And if you want to find out how to escape poverty in 1 month, click on this video.